Hello students, today we are going to start new chapter of part 3rd accountancy class 12, that is accounting ratio. So in this chapter we are going to discuss what is ratio, why they are needed and what are the benefits of analyzing the ratios. Also in this video we solve the first foremost ratios, that is current and quick ratio. Okay, so first of all, what is ratio? A ratio is a numerical relationship between two interrelated numbers or items. Or we can say that the accounting ratio is a numerical relationship between two accounting variables of financial statement, that is income and balance sheet. So we find accounting ratios to signifies the relationship between two individual items or group of items in the balance sheet and income statement, right? So ratios are used basically studying the significant relationship between the amount of turnover and capital employed. Okay, so accounting ratio basically very helpful in analyzing the different cross-sectional or time series analysis of different items. Thus, accounting ratio is a process of studying the financial statements by using ratios on the income statement and balance sheet of the business entity, so that the meaningful conclusion may be drawn in respect of operating performance and financial soundness of enterprise. Okay, so what are the objectives of ratio analysis? Objective of ratio analysis are to know the area of weakness. There are many areas where the company are lacking, so we are required to pay attention on these areas. Information for making time series analysis. We should make time series analysis for knowing the different conditions of the business in different time of span. Okay, information for making interfirm comparison. You can compare ratio and interfirm comparison become quite easy either with the industry's standards or with the best in the firm in the industry. Okay, use for projection of future. Information derived from ratio analysis can be used for making useful projection for the future. You can determine the future activities or future profitability chances. Okay, and supplements the information provided by other analytical tool. It gives some supplement information to the people so that they can make rational decision about the enterprise. Okay, so there are many types of ratio which is classified as follows. First is liquidity ratio. Liquidity ratios are those ratios which analyze the current liabilities as to pay off by liquidity. Thus, liquidity ratios are known as short-term solvency ratio. You should remember this, short-term solvency ratio. Okay. Now, it includes two types of ratio, that is current ratio and quick ratio. Next is solvency ratio, which deals in the long-term debts or long-term solvency ratio. So it analyzes the ability of firm to meet its long-term liability at the time of maturity. Okay, at the time of maturity, even a company is able to pay off its debt or not. So it includes debt and equity ratios, total asset to debt ratio, proprietary ratio, and interest coverage ratio. Activity ratio. The ratio are also called turnover ratio, as these are calculated either on the basis of cost of revenue from operation or from the revenue from operation, cost of sale or on the basis of sale, as cost of revenue from operation is cost of sales and revenue from operation is sales. Okay, it include inventory turnover ratio, that is also called stock turnover ratio, trade receivable turnover ratio, it is also called debtors turnover ratio, trade payables credit turnover ratio, working capital turnover ratio. Last is profitability ratio. It is a prime objective of the firm to earn profit. So the efficiency of the business or profitability of the business is analyzed by the profitability ratio. It includes 5 ratios, that is gross profit ratio, net profit ratio, operating ratio, operating profit ratio, return on investment ratio. Okay, so now we are going to understand the first foremost ratio, that is liquidity ratio. Liquidity here means to ability of the firm to meet short-term obligations. Short-term obligations, that is current liabilities. So first of all, we try to find out the current ratio. The ideal current ratio is 2:1. That means 2 is treated for current asset and current liability is treated as 1. So it means the number of current asset should be just double to current liability. Okay, what is working capital? How you can find working capital? So current assets less current liability is equals to working capital. Okay, current assets include current investment, trade receivable, cash and cash equivalents, short-term loans and advances, other current assets and inventories. As I told you, if you remember the balance sheet by heart, you are able to solve this book very easily. Okay, so in inventory, loose tools, stores, spares are not included. It should be less of, right? So after that, current ratio, liquid ratio or quick ratio, which is also called asset test ratio, is calculated. So asset test ratio formula is liquid assets upon current liability. There is no change in the formula of current liability and it is calculated as calculated in previous, right? Current liabilities include what it is include? All the current side component of balance sheet in current liabilities is included here. Okay, How you can find liquid assets? It can be calculated as current assets less inventory, that is closing inventory less prepaid expenses. Current liability same as current ratio. Now we are going to solve first question. It is from the D.K. Goyal first practical. From the following particulars, compute the current ratio. So what is the ratio? Current ratio's formula is current assets upon current liability. So first of all, we try to find current assets from the questions. So inventory is current assets. Okay. Trade receivable, current investment, and less cash and cash equivalents. Okay. So after that, inventory plus trade receivable plus current investment and cash equivalent, we can find 2 lakh. 70,000 is inventory, 90,000 is trade receivable, 35,000 is current investment, 5,000 is cash and cash equivalents. So we got current asset as 2 lakh. Now how you calculate current liabilities? So current liability can be found just way you see how you calculate current assets. So current liability is trade payables, okay, short term borrowing, provision of tax, okay, and outstanding expenses. Okay. So current liability is 80,000. So you can calculate ratio very easily, that is 2 lakh is divided by 80,000. Okay. So you can solve it very easily, that is 2.5 is to 1. Okay. So as we study that ideal current ratio is 2:1 and this is greater than 2:1, it is 2.5:1, then we can say that the company position is satisfactory. They are able to pay their all debts and they have good working capital capacity, right? So how you can calculate current ratio? You can understand, and in next question we are able to solve some more current ratio as well as quick ratio. Okay, this is the second question of practical of D.K. Goyal of accounting ratio. So first of all, you have to find current ratio and after that quick ratio. So what is the formula of current ratio? Current assets upon current liability. So first of all, you have to choose what are the current assets. Is current investment is a part of current asset? Yes. Inventories including loose tools. So you have to less loose tools, as I told you the loose tools is not included in current assets. Okay. Trade receivable, okay, quite easy. Short term loan and advances you provided, okay. Prepaid insurance, advance payment of tax and cash equivalent. So your current asset will be 8,96,000. After that, current liability, so the trade payables plus short term borrowings and short term provisions and other current liability. So after dividing them, you get 3:3.2:1. It is satisfactory because it is greater than ideal ratio. Now how to find quick ratio? So its formula is liquid assets upon current liability. Liquid assets are those assets which are quickly changed into cash. In emergency we use liquid assets. So its formula is You can less from current asset, less inventories, prepaid insurance and advance payments of tax. So you get liquid assets and it is divided as current liability is already calculated in first question. So it is 1.6 is to 1. So it is good, right? Because liquid assets number is 1.6 is to 1 and it is greater than ideal ratio, that is 1 is to 1 of quick ratio. Okay. Now these questions are quite easy, you can easily solve them, and it is based on some formula. Like you have to following question compute current ratio. So first of all, current asset should be calculated. So total asset is given, that is 40 lakh. Non-current assets are given. So if you less than, you can find current asset. Okay. And after that, current liabilities. So non-current liabilities are given. Shareholder funds and share capital, reserves and surpluses are given. You can find easily how you can find total asset less share capital, reserves and surpluses and non-current asset, non-current liabilities. So you can find current liability and after that you can easily put in the question. Okay. Sixth question is just same as fifth question. So I request you all the questions of DK Goel you should solve in a copy in your notebook because it will used in practical examination. Here I end my video. In next video we discuss some more ratios. Good day.